Here with me now is Ohsung Kwon, the chief equity strategist over at Wells Fargo. This conversation has been daunting. I mean, if you look at the way markets have performed, who would have thought that now at this stage with the war still going, that if you looked at the indices, you'd recover most of the losses, if not all of them, and those people looking at their 401k balances are pretty much back to where they were at the end of February. What happened?
Yeah, I mean, this basically shows that the market and the economy are largely insulated, at least for now, from the oil shock that we saw from Iran. I mean, if you look at oil intensity of the economy, it's down 75% since the 1970s. And only 1.4% of S&P's OPEX is coming from oil, even at $100 oil. And that's basically in line with the late 90s level when oil was $20, adjusted for inflation. So, I think there's still a lot of tailwinds from the fiscal stimulus from One Big Beautiful Bill that's going to provide cushion, at least for the next 6 months. And I think the market's going to be on a sugar high for the next 3 months.
So the sugar high is interesting because, as you point out, energy does not have a massive influence on the markets. It's a very small sector compared to the other ones in the S&P 500, but it has been a massive outperformer. We are seeing a catch-up trade happening with technology amid the sell-off that we saw, not even since the war began, but even before then. What exactly has been propelling that interest, renewed interest in tech, and can it last this time?
Yeah, I mean, the answer to your last question is yes. I think tech is going higher. We like the hyperscalers, the Mag 7. We were bearish hyperscalers for the past months. We turned bullish recently, a few weeks ago, really on the idea that their free cash flow might be inflecting higher. And that was really the reason why we were bearish before that. That free cash flow estimates for 2026 for the Mag 7, the hyperscalers, has been cut by 70% over the past year. And now our analyst actually thinks that that number is inflecting higher because their top line is about to accelerate going forward. There's a lot of capacity that's coming online, and everyone still says demand outpaces supply. And if that's the case, I think revenue is going to accelerate going forward. And the biggest conviction that I have is the compute power is only going higher. AI is really good. That's essentially what the market is saying through software stocks. And if that's the case, hyperscalers probably not overinvesting. And compute power, we're just going to need more compute power going forward.
But that story was also there, to be fair, over the past 6 months, and certainly since the record highs in the NASDAQ that we saw back in October. But there was a souring sentiment about AI, about free cash flow, about OPEX, and everything else that was going to happen with there. What exactly then, sentiment-wise, could change? What exactly was the big catalyst for the shift in narrative away from the bearish side of AI, more towards, hey, maybe it's right-sized and growing?
Yeah, so that happened already. We already saw 70% estimate revision down in free cash flow already. We think that's inflecting higher going forward, which is going to be the positive inflection for sentiment. Also, sentiment was really bearish for hyperscalers for the past 6 months. And that was really the funding short for a lot of hedge funds. And valuation has contracted by about 30% already at the lows for the NASDAQ. So I think this was a valuation reset as well as the positioning reset that we saw in March. And now, I think the risk is to the upside going forward.
All right, speaking of the reset, one of the consensus trades that we saw play out over the course of the past several months, maybe even going back to April at this point, was this idea that some folks out there, a lot of folks to be honest, were long semiconductor names and funding those long positions by borrowing and shorting software names. Mm-hmm. The divergence was massive. It was starting to close at one point over the course of the past couple of months. Do you see that tech trade being that kind of massive split again between hardware-type names and software-type names?
Yeah, we like the NASDAQ more broadly. And you're right. Over the past, it's almost been 3 years since semis really started outperforming software. I think software, to me, is more dead money. I think there has been a significant valuation reset. I mean, we have a funny chart that shows that software now trades in line with department stores, right? So basically, the retail disruptees versus the digital disruptees are trading at the same multiple. So that's how much software has derated already. That being said, I don't really see that much upside catalyst in software because it wasn't really earnings driven, right? Earnings continue to get revised higher for software, but the stock continued to deteriorate. So I still like semis over software, but the broader theme that we have is we think AI bull market is maturing from a CapEx-driven bull market to a monetization-led bull market. So I think we're heading into a healthier phase of this bull market.